So this is going to be a session on term sheets. We have a group of us here to talk through a term sheet and to discuss it from the investor's perspective and from the founder/company's perspective. So from the investor's perspective, we have Damon Crowe from K1W1. Damon is one of the managers there who has been involved with K1W1 for many years, and K1W1 have been deeply involved in the high growth tech sector for over 10 years.
Nearly 20 now.
Yeah, a long time.
Yeah.
Ben O'Brien is the founder or one of the founders and CEO of StretchSense. StretchSense is a company based in Auckland that produces wearable, stretchable technology that can... Why don't you explain?
Measure the body.
Thank you. And StretchSense has been through a number of capital raising rounds, 5 at the last count. So he's well experienced in the process of raising capital and negotiating term sheets. So for the purposes of this discussion, we have produced a term sheet. It's just an example term sheet that we put together as a basis to foster some discussion from these guys. So do download it and look at it as we go through this conversation, but please don't use it as a template. It's not intended as a template. If you want a template, you can go to our website, Simmonds, Stewart, and there are template term sheets and doc makers there. So we thought we'd kick off today with a bit of a discussion around how you get to the point of a term sheet. I think that's probably the harder part, and Ben thought he might give a little bit of a chat, have a little bit of a chat about that.
Okay, so we're here to talk about term sheets, but actually from a founder's point of view, getting to this point is quite a hard road. Expect to be rejected order of 50 to 100 times to get there. Expect to have to rewrite your business plan, I don't know, similar number of times. Actually, you go through a process where you're trying to do something, but then you're getting feedback from investors, from your customers, from your own team as you go. And so things are changing all the time. As a general rule, I don't think you should ever negotiate or try to raise money without getting your company stable and at least at the break-even point first, whatever that means to you in that moment. It could mean no salary, it could mean getting sales or whatever it is, because the bias for investors is to wait as long as possible, right? If you're a company that's in distress, everything helps the investor to wait, because you may pull out of it, in which case, great, that's a risk that didn't materialize. You may go down, great, in which case they dodged a bullet. But in all scenarios, the price goes down if you're more stressed. So, yeah, get your company into a state that's investment ready, get it into a sustainable place, and then settle in for a long road of getting rejected over and over and over again and over again. It's kind of what I think.
Okay, so I think what we'll do is we'll start working through the term sheet. So what we have done is put together a fairly standard term sheet with some provisions which are more founder or investor friendly. Okay, so in the term sheet essentially sets out the key terms of the transaction, as you may have picked up from other sessions. It's really important to set out in the term sheet those terms, and to ensure that you have agreement between the parties in relation to those terms, because once they're in the term sheet, despite the fact that it says it's non-binding, it's pretty hard to move away from them. So it's a really crucial document. Right, so the term sheet describes the business, sets out the parties, it sets out the types of shares. In the term sheet that we have in front of us, it says that there will be ordinary shares. Would that be something you would normally invest in the basis on?
It depends on the stage. I think it's important to stay with a term sheet with all these terms. There can be investor friendly, there can be founder friendly, and there can be fairly neutral terms. Probably at least half of these terms it can be one or other or a mixture of all of that. So the class of shares is really can relate to the stage of the company. But we've certainly got a preference towards a risk-sharing approach, which involves more of a last in, first out, which is more where you get your preferential return on a sale. So if you put your investor money in, you get that out first. Generally, a fairly benign way of doing that is just one time. So if you put $500,000 in, you get $500,000 back before everyone else. There are other variations on that. Anything more aggressive than that tends to be sort of more investor friendly and almost a little bit aggressive. I know certain groups do prefer participating preferences, which is where you get your money and then you share in the leftovers. The good thing about preference shares is they tend to focus the mind on returning investors' capital. A lot of investors are protective of their capital. So we find it a good way to share the risk that if you do invest at a high valuation and things don't work out, but there are some residual value, then you tend to share. You give your investors your money back, and then everyone, if there's anything left over, the founder can pick up the spoils on that. So we certainly prefer to invest on prefs, but depending on the stage of the company, you can do ordinary shares. It's really a risk sharing approach for us.
Mm. What would your approach to that be?
I think I kind of agree, like a 1x preference is fairly normal and standard. Anything more than that, and especially participating shares, is no. That's getting a bit rough. But what you do have to watch out for as the founder is preference stacking. So whatever you agree to at this point, generally subsequent investors are going to get those same terms, and those will stack on top of each other, and you can get into a situation where it becomes extremely difficult for anyone early to get money, and this can impact the early investors as well. So this is structured to be like a very, very early stage company. Looking at this term sheet, it has things in here which I'll talk about later, like you will have employment agreements, which is ridiculous. That should be done ahead of time. And so one thing to keep in mind is that if you establish with your early investors preferences, whatever they are, the later investors will get those, and because they may be putting in a lot more money, and because you may come out of it all with like a mixed, not really great but not really bad, everyone who's early may not get something back because of that. So in some sense, be very aware that the game, like right now, say I'm negotiating with Damon right now, but couple of rounds later, we're actually going to be on the same side of the table dealing with a larger investor, larger company. And so we're kind of establishing the ground rules for that negotiation now. So just be careful of that and think forward. And I guess one other point, when you're dealing with investors, it's really helpful if you can articulate what the capital raising story is going to be. Right, here's the eventual exit that we're most likely to target. We think we're going to do 3 rounds to get there. Okay, that means this kind of valuation, that kind of valuation, that kind of valuation, that kind of valuation. That will then set what deal you should do now, and it will set what kind of terms you want to do now, because you can say, we're going to be dealing with like, I don't know, a nasty PE firm or something here. What can we put down now that makes life better then? So I would I guess what I'm saying is 1x preference, yes, but just be aware that you're setting rules for a future game.
You know exactly. I think and part of having an idea of what your financing strategy might be over time helps, because if you are going to then follow on, to then go and find professional investors, a fund or so forth, that what you set here will be mirrored further on. So the more aggressive these terms are, the more aggressive the following rounds will be. So I think the other thing is, just touching on ordinary shares. Ordinary shares work really well at a very early stage and at the profitable stage. So, if someone's putting in $10,000 to write a business plan, obviously no one's going to ask for prefs. But and similarly, if you've got a company that's turning over $10 million and profitable, you tend to use ordinary shares there. It's really that risk sharing in the meantime, where you're asking for significant amounts, maybe $500,000, $1 million or more, and on the flip side, there's virtually no assets in the company, so it is all goodwill, and so just having that capital return through a pref structure just tends to, in our view, just even that whole risk thing out. So, but again, a good question for lawyers too, because I think they can help just explain that too, and make sure it is just that benign one times pref, and that there's no sort of other things sneaking in there. So.
Yeah, and I'd say that in our experience in the investment community in New Zealand, the standard would be 1x non-participating pref. But there are investors like the Australian VCs are requiring participation rights and other things, preferences on dividends and things. So you do have to be a bit cautious. So the next thing you need to be really clear about in your term sheet is your pre-money valuation. That is one of the matters that will usually be discussed at length between the investor and the company.
Again, it's a risk-sharing thing. The type of shares and some of the other minority terms can influence that, although it tends to be more the stage of the actual business itself. So, there's various different models, not a DCF or anything at this stage, more what stage is your prototype or your early release at, and it tends to be at certain bands. So we don't like to see people sort of trying to buck the trend, so forth. There is a bit of a trend, especially with prototype and early revenue companies, because we all know things change pretty quickly, and it's pretty hard to justify outsized valuations or some sort of difference to the mean. So they do tend to be in fairly narrow bands. So but it is an important number, but one that is very probably one of the most negotiable there in terms of coming up with a number that works. And I guess, like all negotiations, if both parties are a little bit unhappy, you've probably struck on the right number. So.
Yeah, I think that's a good way to put it. There's a famous saying, you set the price, I'll set the terms, right? And so valuation's a tricky one, because you have to be willing to have the conversation fairly early in the piece so that you're not completely, at different levels. Because if you are, you get these horribly disappointing conversations where everyone's like, oh, if you're wasting all our time, So you got to have it early. But you should never really anchor to a valuation until you see what all these terms are, right? Like, for example, we just talked about participating preferred. That completely changes the valuation that you think you can get, right? One thing in here that I really dislike is subject to the achievement of milestones, which we've kind of skipped over. I like to talk about that. As a founder, you should look for levers that grow your value. Things that will grow your value is competitive tension, right? Talking to more than one investor will grow your value. Having a viable business will grow your value, right? If you're making money, or at least break even, then you're going to get a higher valuation, just very simply. Being able to articulate benchmarks. So what Damon just said was, we know there are certain bands, right? So you say, okay, what are the bands? What range is the community investing in? And then what can I do to be on the high side of those bands? You're probably not going to get outside of it. It's be realistic. But if you can articulate, well, yeah, these are the hallmarks of companies in this valuation range, but we have this and this and this and this, so we sit here. That's a game you can play very, very cleanly. Being willing to walk. You have to be willing to walk, because if you're not, you will not get anywhere near what you want. I think one other thing which is important to think about is the actual amount that you raise is one of the more interesting levers that you can pull. This one here is based on achievement of milestones, which again I don't like. We can talk about. Yeah, let's go back to that. But it may be that the valuation you command and the amount of dilution you're prepared to accept mean that you should be raising less money. It's possible that that's an outcome as well, and that can be a way to line up the parties. So I don't know. Those are some of my thoughts.
Yeah, I guess they're good points, and there's a couple of key ones there. I mean, I think from the valuation perspective, if you have got a plan where you're going to raise multiple rounds, and if you do go out too high too early,
you can stuff yourself.
You miss a milestone, or you miss, even if it's not a formal milestone, you just miss a revenue point that you should be at if you want to be a certain growth metric, not even a written down milestone. Doing a down round or having a flat round can be very uncomfortable conversation. When you go to do that next round. So again, another reason why there tends to be bands of valuation, because you know that if you're going to raise another round, then you want to step it up as opposed to sort of all over the place, because they're very uncomfortable conversations with existing investors. I think the amount's an interesting one too. I mean, there's different philosophies on that. At certain times of the economic cycle, it's really much get as much as you can, because you never know where the next dollar is. if you've got the luxury of being able to pick and choose, and there's not many companies like in that boat, you can sort of tailor it. But again, it's there is a focus on how much the founders retain, because a lot of investors do back the founders through multiple rounds. So if you dilute the founder too much, you can then find that you lose some of those future investors. Not all investors are like that, but it's just something to keep in the back of the mind, that raise the right amount to, I guess, achieve the right structure within the company. It is a real minefield. We probably tend towards take more than less, because there's nothing worse than missing a key sort of growth metric. But it is one of those discussions that we have right up front, often in the first meeting, because, like you said, it's another good point.
You want to be aligned, right?
Yeah, there's no point in investor doing weeks of due diligence to find out there's no deal to be done. So we try and approach and see whether there is actually a deal in the first meeting. It is one of those upfront things that you've got to be prepared to answer and have good answers. Otherwise, you can find yourself slipping down the bottom of the range. So something to be prepared for.
Yeah. In our term sheet, we have said that the investment amount, in our case 500,000, is subject to the achievement of milestones.
It shouldn't be.
No. Well, the way that works is that instead of the 500,000 being invested in the company at completion, so when you sign the documents and have satisfied all the conditions, instead of the 500,000 going in at that one point, it's fed in over a period of time, subject to the company achieving specified and agreed milestones. Now, clearly, there's a risk there for the company because the milestones might not be achieved.
Subject to achievement of milestones, the most toxic thing about that is not risk on the company or founders. The most toxic thing is that you are guessing today what a successful business plan will be, and that will distort everything, because now, instead of maximizing shareholder value, instead of growing a good business, the company has to maximize achievement of milestones, which were a guess at a point in time. And that is what makes that just, I actually think that doesn't benefit the investors either. The investors should get control by having directors, by having regular reporting, by being able to be part of the conversation, the strategic conversation about where the company's going. What this says to me is, first of all, they don't actually trust the team well enough, because they're trying to put in these extra artificial things. The person who's proposed this term sheet doesn't understand that this is will destroy the ability to focus on what really creates value for the company. I just don't like it. If there's really a key milestone that needs to be hit, whatever it is, invest less and do another round if that's really a problem. I don't know. I think there can be some place for a larger company for milestones. Like if there's an established, proven business model, and you're more worried about execution against that. It's like, hey, this works. We want to do it in Australia, or or whatever. Like if it's that kind of an investment, then sure, I could understand that. It makes more sense. But for a company like this, I just think it destroys value for everyone, because it's the wrong way. Everyone, if we have a theory about how to make value, if that changes in a month, we should sit and talk and do that, rather than be like, well, no, but the investment sheet says.
There can be a case for sort of one or two milestones. We tend to be, I guess, either prefer no milestones or very light milestones. So if someone says you're going to have a prototype built in 3 months' time, well, then you might say, well, here's the money to build a prototype within 4 months, and then you get sort of the next stage. So I think they've got to be very achievable, almost founder-friendly milestones that are either obvious. So if someone hasn't built someone within 4 months, then clearly there's something terribly wrong.
I would say that from what we see in the market, milestones have become much less common than they were a few years ago. So I think there's quite a lot of alignment between investors and companies on that now.
This valuation is calculated on a fully diluted basis. So for the viewers at home, what that means is that any options or things that aren't actually shares, but where someone has a right to shares, are calculated as if they were shares. And then if you jump over to the ESOP section, it says an ESOP plan will be established by the company prior to completion. So one of the traps here, especially for the founders, is that the dilution from that ESOP can come out of your shareholding and not the investor's shareholding. And so now that might be okay, but it should be extremely clear in where that's coming and what happens. because otherwise what can happen is you get into this weird situation where the founders are being diluted by the ESOP, and they're the ones running the company. The investors aren't, and so post-investment, the incentives for the founders are to not use the ESOP. That can be a point of risk here. So I'm kind of flagging it. It doesn't kill a deal, but you have to be really clear that this game around when an ESOP is provisioned for can often, especially if it happens before an investment round is completed, it can be a point of divergence, and that one group's incentivized one way and the other's the other way. So having that really clear and explicit, and if you are being diluted more than the investor, then guess what? The price can go up a little bit, right? Because that's, in the overall negotiation, one person's wearing more risk there. So just want to be...
Yeah, I think ideally there is a schedule here for a cap table, and generally just about all the term sheets we sign or are part of too, that's already been fleshed out, so that the entrepreneur and the investor
know exactly
whether it's a 10% ESOP or 5% or a 20%. And again, it all depends on who's in the company and what the company's going to need down the track as to whether it's between 1 and 20% ESOP, but generally for an early stage it might be 5 to 10.
5 to 10, yeah.
But that's clearly mapped out.
Yeah, that's the key point. Is if it's not clearly mapped out, what happens is everyone gets to the line, and then they suddenly say, "Oh wait," and suddenly someone has to lose value. And yes, as long as it's got to be clearly mapped out, that's the point.
Really important that the investor in the company understand the cap table from the outset and are really clear on what's in there, because that sets valuation, price per share, and clearly this dilutionary effect of any ESOP that's agreed. And there have been a gazillion examples of the cap table, instead of being the first thing discussed, being the thing that's discussed just before you're signing the documents, which is a position I'm in right now with a deal. Amazing.
Yeah, and that is the problem.
Yeah, it is. It's surprising people don't focus on it until the last minute, even though it's been circulated a zillion times.
I think just one other point with cap tables, always be able to work in terms of price per share, and as a founder you need to know how to do a cap table, and it's actually more complicated than you think, but once you get it right it's very straightforward. That should never be something that investors are providing to you. Also, not only should they not be providing to you, you should have your own cap table and know the state of your company, but also that's kind of how you scenario plan for different investment outcomes, right? You need to be able to calculate, well, if we raise this much money at this valuation and then these things happen, this is what will happen, and we'll get this much money on exit and they'll get that much money. You need to be able to do all that scenario planning, because that is the playing field for the negotiation. So learn how a cap table works really, really closely, and be very comfortable with that conversation before you start negotiating.
Yeah, make sure you have that discussion about ESOPs, because some investors, they do think they're only for very key staff. Other investors are quite happy for even the secretary or so, the doorman to have have some shares. So it is something that needs to be discussed up front.
Yeah. The other reason for making sure you retain and manage your own cap table is because your investors will have their cap table as well, or usually they do. It's so that you can do a check, because if there are discrepancies between those two cap tables, you need to figure out why that is. And there are occasions when it's the investors that is wrong, and so everyone needs to know they're on the same table, and you don't want to be relying on theirs if you don't have yours to check against.
And actually agree on the rounding method. One of the, you will...
That's true.
No one thinks about it, but as the size of your rounds, so rounding for rounds, as the size of the amount of money you're raising goes up, then the influence of the number of decimal points of your calculations become more and more important. At the beginning, it doesn't really matter. But after a while, you find out that you need 4 or 5 decimal points, and there's still 10 shares here or 10 shares there, or so many dollars here or so many dollars there. And it can be really frustrating when you're right up against the line and you suddenly find out, well, okay, wait a second, we've got $80 of shares that we don't know how to allocate. And these deals are incredibly structured. So everyone signs it 1,000 times. There's usually 3 or 4 different sets of documents and the definitive agreements. Everyone's signing everywhere. So to just arbitrarily give someone extra shares is not easy to do. You just can't do that. And so being clear about just just the mathematical precision of your calculations up front is actually something that's really important.
But just on ESOPs, I mean, and just segueing a little bit in terms of your math, I mean, one of the things we've found with ESOPs is generally once you've decided on the numbers, it's pretty much a lawyer's game after that.
So the next provision in the term sheet that can come up is a founder lockup. And what a founder lockup is a restriction on the founders from selling their shares for a period of time. And I can explain what that's about, but I guess I'll leave these guys to talk about it. So Damon, is that something you look for?
Yeah, generally. I mean, there's a few terms here that kind of go together, and this is one of them. Founder lockup, obviously, for an early stage investor, you're backing the person, so the last thing you want them is to bail on you. So if they're selling out, you want to be selling at the same time. Really, founders shouldn't be selling until the company's profitable. It really is a real high level rule of thumb. Even then, you've still got to ask questions as to why founders are selling. Although there is, if a founder, if it takes 5 or 10 years for a company to become profitable, it's not unreasonable for a founder to want to take some money off the table at that stage. But certainly at the early stage where the company's quite young and you're really backing someone's word on that they can finish a prototype and launch a product and get some early revenues, you're really wholly reliant on them. So if they're selling, then that's a real red flag. So quite a reasonable provision for an early stage company.
Yeah, I think I generally agree, although I'd maybe tweak some of the numbers a little bit and add some more exit clauses would be my thinking. So 3 years. I mean, in one sense, no one should be able to sell shares without a special majority anyway. So telling a founder they can't sell shares when no one can transact anyway, in some sense, is superfluous. I've seen more commonly provisions like if a founder quits operationally, they may be some kind of share penalty, which I try not to have it, but that's often where it goes.
It's the next one.
No, that's a separate one. I didn't even put it in because I do think it's so draconian. So what Ben is talking about there is if a founder ceases to work in the business. So what we were just discussing is not selling your shares, but if a founder resigns, what should happen there? And in some circumstances, investors will ask will require that those shares be bought back from the founder, and sometimes at a punitive discount.
Yeah, or nothing. So I guess that's my point. Is like I agree with Damon that you back the jockey, not the horse. But share sales themselves are generally so controlled. Like I'm sure there's vetoes that the investors will have to block anything. There'll need to be a special majority. Like there'll be so many layers of protection around share sales for a company. Like this is not a publicly traded company, right? That generally doesn't come up. So
it doesn't get triggered.
It will never get triggered. There's no scenario that gets triggered. So the more relevant scenario that will come up will be people will say, well, okay, that's fine, but what if you stop working for the company and you just want to become silent? And so I think in that provision, when that comes up, I'd like to have some kind of provision for sickness or disablement or force majeure, act of God, whatever you want to call it. That's important because it could be that your partner gets very, very sick and it's totally outside of your control, and that's just life. And so I don't think that the investors should be protected from common risks outside of your control. They should be protected from you saying you'll do something and then just getting cold feet. That's where I think the protection should come in.
So another provision that's in the term sheet is founder vesting. Founder vesting is a provision which means that despite the fact a founder may own, say, 40% of the company at the time the investor comes in, if that founder ceases to work in the business within a specified period, often 2 or 3 years, the company has the right to buy back some of those shares, so that the founder may end up holding only 10% of the shares in the company because his shares have been bought back because he ceased to work in the company. I
think I just add to that. So from a founder point of view, one thing you want to be really careful of here is that, like Damon said, we're backing the founder, so they shouldn't leave. And that is fair enough, which is why you're going to have to agree to something like this. Okay. The problem is there are other scenarios that can lead to an untenable employment situation, right? Which the investors can cause. So for example, the investor might change. Like maybe I really like Damon, he's a fantastic guy, I've known him for 10 years, I'm like, I'd like to back him as an investor. But then he gets sick, someone else from his fund replaces him, and that person just sucks. They want way too much information, they're meddle with the business, they come in, they talk to the management team and bypass the CEO. That person sucks. And at that point, the founder's now in a situation where their business is being destroyed by the actions of the investor, right, whether directly or indirectly, and they may want to say, like, you know what, I threaten to quit unless you change your behavior. And then something like this can come and bite you really, really hard, because the investor, who's not Damon, not the person you had the relationship with, can say, you know what, take it. So just...
I mean, this is where the devil's in the detail on some of them, because, I mean, this is a fairly general clause. And it's one where you should have certainly in the first draft of the term sheet, it's really something that needs to be discussed, because, you know, certainly over a period of 36 months, you would expect something like that to be very unusual.
Yeah.
So in the full document that this leads to, you can actually have some exceptions where there's a change of control, or you can have where it's usually monthly vesting. You can have a cliff where you get shares after 18 months if a certain action occurs. So this is a very general clause for what could end up being quite a detailed clause with a number of exceptions. Something that just needs to be discussed up front, but just to be, to be aware that it is becoming fairly standard that a large block of unpaid shares are often being expected to be put at risk.
Yep.
Yeah.
And again, I think to the founders, I think that's okay. But like Damon says, you need to be thinking, okay, what if it goes wrong? Not because this is to protect the investors if the founder does something wrong. But from a founder's point of view, you should be thinking, well, I intend to stay in this for a very long time. It's going to take you 10 years, so this is okay. But you should be thinking, what if it goes wrong because of the investor's point of view, and if from the investor point of view, and if you put...
That's where you've got to do your homework too. I mean, it's sometimes up to the founder to make sure that if you're getting a fund or an investor on board, that you've satisfied yourself that they're long-term investors.
Definitely.
There are fly-by-nighters, but again, that's up to the founder to really make sure they're not being backed by a fly-by-nighter and someone who is in the game for the long term.
Yep.
But again, a negotiating point.
Yep.
So another point that will be in the term sheet is an explanation of the fact before the company issues new shares, it will need to offer those shares to the existing shareholders, specifically the investors. Completely standard, you don't need to worry about that, and I don't think we need to discuss it. The point that can be discussed and can be slightly contentious is whether investors have the right to oversubscribe, which means not only do they get the right to subscribe for their pro rata allocation of the next round, but they also get to say, oh, and in fact I want to take more of it. Now this can be an issue for a company because they might want to take a new investor on board because that person has connections they want, or usually connections, industry knowledge, something like that. And so if their existing shareholders take the round or take more than their pro rata allocation of the round, it limits their ability to take on that strategic key investor. So it can be a point to be discussed. What's your K1W1's view on oversubscriptions, Damon?
Again, that's probably mainly a discussion point, and it depends on the stage of the company. I mean, if it's a large capital raising and you've identified the need for a specific, say, strategic investor, or you want an institutional investor, then you're going to sit around the table before you go and talk to those at that second round and say, well, if we need an investor on board, they're probably going to want 2/3 of the round. So get the key existing shareholders around the table and say, well, this is what we think. So there's the formal rights, and then there's sort of the informal discussion you have as shareholders as to what the strategy is. And sometimes it can be a bit hard to marry the two up, and you're sometimes stuck with historical, where you think the company might have been going one direction, and you want to bring on a new investor, and the terms make that difficult. One of the areas we find that is if you have to go through a preemption round before you go and talk to a new investor, that can be quite difficult, because strictly speaking you should offer it and then you don't even know what the new investor's going to want. So that's where you've got to get the board and the founders have got to get the existing shareholders around the table and make sure you're on the same capital raising strategy. Just for us in particular, and I know a lot of funds, your preemptive rights up to your pro rata is one of those things you never give up. You want to be able to follow your winners. Yeah. The oversubscription one's a bit of a grey area that you sort of need to sit down with all involved at that point in time. Yeah. It's nice to have, but it's probably that base pro rata that you're really concerned about. And then sometimes, if you do really want to oversubscribe, then sometimes you have to put your hand up and say, well, we'll lead the next round. So again, it's a real discussion point. Yeah. But it can be, as if it's poorly worded and you've got some, and this is where you've got some shareholders that are out of the loop. That's where it can get difficult, and that's where it's sometimes up to the entrepreneur and the board to bring all the shareholders along with them, and communication can be key. Yeah. There's nothing worse than finding out a company needs money and you haven't heard from them for 12 months. Whereas if you're getting regular updates and you're on board with the strategy, obviously that's a lot easier discussion as well. So it can be a difficult one legally, putting that down as to what strategically the company might need. Yeah, it can sometimes be a little bit different.
Yeah, I think I'll let you respond to, Ben, but in practice you're absolutely right. Regardless of what we put down in the legal documents, when you're doing a follow-on round, companies should always be speaking to their existing shareholders and investors to get a sense of whether they're interested in investing and before you start embarking on the legal processes to get your round away.
Yeah, I agree. Communication, this is kind of pointless in some sense, because the investors will have vetoes on investment, you'll need a special majority, and they'll need to have been part of the planning process anyway. So for you to get to the end stage of a subsequent capital raise and then have a clause like this block it is just inconceivable, because there's 3 other ways they could block it. You'll have had to have talked anyway. So it's kind of moot. Not to mention, every single time you do a new round, at least in the early stages, you're pretty much going to throw away your whole company documents and start again from scratch. It's just like sometimes twice within the same negotiation. Like you'll be amazed. So things like this, I just wouldn't worry about. If you're the founder, you just have to communicate. You have to keep your investors along for the ride. And basically, if an investor doesn't want you to do a new deal, it's not going to happen, because they'll block it every way they can. And if they want you to do a deal, why would they do that and block it using something like this? It's just not. It's not super relevant, I think.
Well, where it becomes relevant, I think it's a bit difficult to discuss, is in the distress state. So if the company hasn't performed and some of the entrepreneurs and some of the investors want to restart, but to restart you have to sometimes reset the valuation. That's where these terms can become quite difficult, because they do entitle the existing shareholders to certain rights, and if you're wanting to sort of issue shares at say half the previous round, that's when these become quite difficult. But the best things to try and avoid is come in with a sensible valuation and achieve your growth targets. And these things, as you say, just get thrown out the window.
So the next thing, which will be really standard in any term sheet, is anti-dilution protection. What that means is exactly on point. If the company raises capital at a valuation which is lower than the existing round or the last round, then the investors in the last round get a top-up of their shares to compensate them for that. And the magic in this is what formula will be applied to calculate the number of shares that the existing investors, how many shares the existing investors get for a top-up. And I am not going to go into the maths on this, and I don't think we want to do that. Ben might want to.
I kind of do. So.
Well, this is the middle of the road one.
Well, you want the broad-based weighted average rather than narrow, which is why I put that. But
so I guess one point here, you're going to have some anti-dilution protection. That's just table stakes. That's okay. But in my experience, most people signing these documents don't understand what those words mean at all. And to actually understand it, you need to use numerical analysis. So it's actually like early stage university mathematics to work out what actually happens.
It can be, if you're concerned about it though, if you're doing a cap table, it's actually not that hard to whack an example calculation.
Yeah, exactly, which is exactly where I was going to go with it. So make sure that you understand what that is and build a calculator. Just do it, and then do it. Well,
Well,
if you've done hundreds of them.
First year maths, really. It's not.
Yeah, exactly.
It's not complex math.
But if you're in engineering or a mathematical background, great. But if you're in some field that doesn't have mathematical training, just know what this means. You will have to do this to some extent, but know what it means and have a worked example so that you actually know what the details are and how it plays out. I guess that's my key thing, because I remember when we first saw one of these, one of our early rounds, and everyone around the table was just like, well, that's standard. And they said, well, what does it mean? And they said, well, it's standard, that's what it means. And so you go away and you do the calculations, and then just don't sign up to something that you don't know what it means. Never sign a document with a term and you don't understand. I think that's the point.
Yeah, and also it is key because there are different calculations. There are different standard calculation methods, and you may be told one is standard, but there are some that are more favourable to founders and companies than others, and so that's really key to understand that as well. In any term sheet, you will generally set the maximum number of directors. That's because it sort of ties in with the representation that the investor has and the number of voices at the table. And it's common, I would have to say, that number is set at 5 or 6. Do you have any views or preferences as to the number of directors?
Practically versus the documents. I mean, practically for a very early stage company that's just building a prototype, you want 2 or 3.
Yeah.
But you might have a provision for up to 5 as the company grows. I mean, for a company that's just engineering and beavering away, you just want them to have your head down, bum up, and not be overly having to keep a multitude of directors informed. As sales grow and the complexity of the business grows, you clearly want different skill sets and a bigger board. But the number is what works best for the stage. One of the keys is balancing things up. Ideally you want sort of, say if it's 5, you want two investors, 2 founders, and maybe an independent. You kind of want a balance. You don't want sort of a board stacked all in favour of one group or the other. So a lot of it's really about finding the balance and then finding the right number for the practical stage. But the documents often, you more document a decent sized board with the right balance, and then whether that's fully filled out or not is dependent on the stage of the company.
Yeah, I kind of agree. The thing that was most glaring to me here is the only person with the right to appoint a director is the investor. And that feels wrong to me. I think the founders should be able to have a couple of seats on the board that they can appoint. Ultimately, they set the company up. That's fair. One thing to be aware of, directorships are really interesting because they sit right at the heart of legal obligations to shareholders in the outside world, liability for things the company does wrong, like tax or health and safety or whatever. Then there's control of the company and what happens and strategy and where it goes, setting the culture, and also, as a founder, you signed up to do a company often because you not just have a vision about some cool product, but you actually want to learn and you want to grow and you want to become, skilled. And so directorships are also about the founders becoming skilled and learning and getting to work with interesting people. And so that ball of different obligations often pulls in different directions, very, very often. And then it changes through time because at the beginning, beavering away on a prototype is different to scaling international sales. These are different things. So you'll have different skill sets that you require. And so it's one of the most interesting spaces for, thrashing out that equilibrium between all those different things. But I would certainly say, there should be a balance. Be at least kind of one person from each stage of investment should be represented there somehow, representing different blocks of shareholders, even though you actually have an obligation to all shareholders. That's the other interesting thing, right? You get, theoretically, all the directors represent all the shareholders. In practice, directors will represent shareholder blocks and may even have legal obligations to those shareholder blocks. So it gets very interesting. I agree, a balance is what you would look for.
And often you see sort of thresholds. So if founders or investors have got certain percentages that they're entitled to, and that's just a good way of, especially if an investor sells out, you can have, say, as long as they hold 10%, because that way if they end up with just one share, you don't have a guy with one share with an entitlement to to the board. But again, it's just really a negotiating point and trying to balance it out for what works.
Yep. And I would say, just thinking back, all these terms link together. So thinking back to the lock-in period for founders, I would definitely tie that to having a directorship and the ability to appoint directors.
Founders have got prepared to pay fees.
Yeah.
I mean, not exorbitant fees, but I think there are obligations on directors now, as you say, with the health and safety legislation, that it's unreasonable to expect directors to do this out of the goodness of their heart, unless they are a major shareholder. They might do it for some options or something, but
I agree.
You've got to be prepared to pay a reasonable amount. Not above the odds, but as you say, it's becoming more onerous on directors. So if you want the right person, you do have to remunerate them in some form or other.
No, I just straight up agree with that. I think probably the only area is setting rules and norms and like a remuneration committee or something, so that it's transparent. The risk there is that the directors pay themselves, and then it's not really to the founder, it's more to the shareholders, and the shareholders turn around and say, oh wait, that wasn't fair and reasonable. So I think the directors just have to have a really clear and transparent basis for getting paid. And on a practical basis, when that goes up and down, having good documentation about what value you got for the company is important. But yeah, I agree.
Okay, so then approval rights. In your term sheet, there will be some matters which need to be approved by the investors. Generally, the mechanism for that is that that it needs to be approved by the investor director. That's just more pragmatic. It's easier logistically to get that approval sorted out. And there's a whole list of things, and usually they're not contentious. They're material transactions that the company might undertake, and the investor director needs to be across those. I think the most contentious one, in my view, and jumping ahead slightly, is whether an investor director needs to approve the issue of shares. Ben, I think I know what you're going to say here, but it might be different from my view.
What do you think I'm going to say?
Well, I think you're going to say they have to.
Yeah, yeah. That's what I was going to say. You're good.
Yeah.
No, I kind of think, there's a minimal amount. Like if over time you've had multiple rounds and someone only has a small percentage of the company now and they haven't participated in subsequent rounds, then I think that could go away potentially or get aggregated in a block. But yeah, every time we've ever done a deal, the investors have demanded this, and it kind of seems reasonable to me. I guess maybe just to quickly give my high-level thoughts on this. These vetoes are generally not contentious. One thing that tends to happen, though, is they don't capture the evolution of the company. So, like, whether 250,000 or 50,000 or whatever, if you're in a growth company or a declining company, in both scenarios, these numbers don't really make sense. If you're on the rocks, directors are probably going to approve every dollar is where it's going to go, right? Like every dollar, and you're going to have like weekly solvency meetings when times are tough, and you're going to have really close relationship between the CFO and everybody. When times are good and you have to move really fast, then these thresholds become really stupid arbitrary, and the focus is on moving quickly. And so encapsulating the authority at a single number, it's almost completely random if it's going to be appropriate or not, or holding you back.
Yeah, well, so my view is that in a high growth company which is relying on capital raising to grow, it does seem a little bit dangerous to put that growth in jeopardy because your existing investor has to approve it. The investor comes in knowing that it's a high growth company which will grow by future capital raises, and investors do have protections through the anti-dilutes, through their pro rata preemption processes.
So I'm a wimp is what you say?
No, we've had this discussion before. But I do know that in practice it's a really hard one to win, and I would say that in a majority of cases the directors do get this veto right over new share issues, but in theory I don't think they need it or should have it. But interested in your view, Damon.
It's one of those ones that some people like it, some people don't. As long as we've got our preemptive rights in there, we tend to be reasonably neutral on this one. Because we do have our policy is generally we are long-term investors, so we invest over multiple rounds, so we tend to be more worried about some of the other provisions. I think, I guess when these things get triggered is when you start to worry. You know, if there is some disagreement by an investor not wanting to invest, to issue shares, or an investor director, then you start to ask questions as to why they're not working with the entrepreneur on that.
Okay, so one of the other terms in the term sheet will be a list of conditions precedent, and these are matters which will usually be in any term sheet, and these are matters which need to be sorted out before the investment can complete. Often these things are sorted out before even the long form documents are entered into, and don't necessarily make their way into the long form documents, and they're almost like a checklist of things that need to be tidied up. Did anyone have any comments on any of this?
Yeah. There's some terms in here which, as far as I'm concerned, are just basic hygiene things that you should have done in your company immediately. So entry into employment agreements, any non-compete provisions, assignment of IP. Like, these are fine to have in this term sheet. I got no problem with them being part of the checklist. But seriously, if you have a company and you haven't got IP assigned from all the people working on it, you're in deeper trouble. Because you own nothing actually at that point, and people can extract extremely onerous terms to get back what you've paid them to do. So looking at this, just have that stuff sorted out immediately. If you haven't already got employment agreements and IP assignment, just go sort it out. Like, now, forget about raising money, just go sort it out. That's my advice.
Yeah, I agree. I mean, investors have got a lot on their plate, and if sometimes, if things drag on, they're looking for an excuse to not invest sometimes. So, the easier you make some of these things, the more preparation done, the easier it is to get these things signed and get the money in the bank and get underway. So, good hygiene. So,
in a term sheet too, it will often describe broadly the type of warranties that you'll need to give in the long form documents. In the long form documents, you'll need to give pages of warranties. Usually in the term sheet, there'll just be either a 1 paragraph description or maybe down to 3 or 4 paragraphs. Did you have any comments?
Yeah, you can see because I've drawn a box around it. It's a trick. Just be really careful. You have to be prepared to stand behind what you say. Like, that's a very core point. You can't be lying. You have to be prepared to stand behind what you say. But warranties are extremely serious, and you've got to make sure that they're not unfairly onerous. So just here it says all information provided to the investor, excluding forecast and other forward-looking information, is true and complete in all material respects. Well, that to me is a little strong. Like, first of all information, I'd like it to be all written information. It gets really grey when you've had many conversations, you've sat down over beers and talked. They may have talked to your employees, to other people. Like, the spread of all information is large and uncontrollable. So at the very least, get it in writing. The investors should be asking for stuff in writing anyway. Like, okay, that sounds great. Give me the business plan. Give me this. Give me the analysis of IP. Give me your freedom to operate. Whatever it is. So at the very least that. And generally, I would look for best of knowledge and belief there as well. Again, depending if it's really core to the business, sometimes it's just your risk and you have to be prepared to take it. So, but just be aware that it's very easy to slip into overreach where you're warranting things that you just don't know, or you can't warrant, or you haven't been able to control. So I'm not saying yes or no there, I'm just sort of saying be really careful. Warranties are very serious. You do have to stand behind your word, but make sure it's really your word. Make sure it's not accidentally additional information that's coming in.
Absolutely agreed. Warranties are really important parts of the long form documents. You need to be really careful with them. Despite what you say in your warranties, you do have an underlying obligation under the Financial Markets Conduct Act not to be misleading or deceptive. So regardless what you put in your documents, you can't be misleading or deceptive, which I'm sure no one would be, but that's the threshold. So it's really important to note that most of the terms we've been discussing, believe it or not, are not binding until you sign your long form documents. But there are a couple of terms which will be binding in your term sheet. And those are usually your exclusivity, if there is one, and confidentiality. And there'll always be usually a confidentiality provision. That's not contentious. Other than just being a wee bit aware of that, because you need to be able to talk about your term sheet to your shareholders and potentially to other investors. So you need to make sure it accommodates that. But more importantly, exclusivity. Now, exclusivity means that you can't talk to any other person about your capital raise. So you're bound to only negotiate then with your investor or investors who've signed up to the term sheet in respect of this capital raise. and there are different views as to whether that's appropriate or not. Ben?
Yeah, I think this is straight up a power term in some sense, because if you negotiate an exclusivity with an investor, then so there's some different scenarios. Let's say that you want to do a deal and things are looking good, then the investor can use the exclusivity to stop you getting other offers on the table, and can use it to wait a bit to see if the company needs the money a bit more. Now, I'm not saying that's something someone will explicitly set out to do, but it is an underlying dynamic. If things aren't going well and you're under exclusivity and you're not likely to get a deal, but they kind of want to think about and sit on it, and you want to say, no, this is no good, I'm moving on, this can stop you from doing that, very, very truly. And just generally you want to have different options on the table, and there'll be periods of time, like for example, where you give a whole bunch of DD information, investor goes away, reads it for a few weeks. That's a good time to be building a plan B, a plan C as the entrepreneur in case the DD comes back bad. So generally, I don't think you should do an exclusivity if you can avoid it. Sometimes you can't. Sometimes it's a power tip. Sometimes the investors will just say, no, this is my offer, I don't want to put all my time and effort into this deal and have you walk at the last moment and waste all my precious time, all the rest of it. But this is very much it's a very much a carving up the pie term. There's not a lot of ways to make the pie bigger. It's a straight up zero-sum game. So I say no, but you may have to live with it. But try to avoid it if you can.
Just depends on the sort of stage and state of the company, really. I mean, if some investors get worried about it, others a bit more relaxed, and again, it depends on how much has been syndicated, what the lead's doing, how much work they have to do, and it's not one that it is quite common, so just
it is common,
understand why you're signing it away if you are. That's probably the main point.
And in this term we're basically talking about, we've provided for 90 days, which I do think is a long period.
Yeah.
You probably wouldn't want to go beyond 60, and if you were going to sign up with 30 would be better, because you do want to incentivise everybody to act quickly.
Preparing a DD library is a lot of work. It's weeks and weeks and weeks of work, getting all material contracts, getting all the finances, getting all these business plans and things, getting just everything there, customer databases, whatever it is that's required. Getting that DD library, it's really important that you've got it in a form before you sign this. Have it ready before you sign this. Have everything you need good to go. You should have that as company hygiene anyway, but the reality is it will take time and effort. Because during DD, you don't want, time kills deals. You don't want it to take time. You don't want people coming with questions and a week or so later you get it to them. That will kill your deal. Also, you look unprofessional.
And also be nice, there's a lot of these terms haven't changed. They've evolved. There's a lot of resource on the internet. Simmonds, Stewart have got templates. A lot of the angel associations have got templates. VCs are putting out templates now.
Yeah.
But, it's not hard to find this information and be prepared.
And I guess my final point is, despite Ben's comments earlier, don't be scared to see your lawyer about this. Hopefully this has flagged that there are some nuances in term sheets, some provisions which may on their face look pretty bland actually do have some quite serious implications to you. So it is important to have a chat to your lawyer before you sign them. So the term sheet discussion we're having today is based on an equity capital raise, which means you're issuing shares. Another common way for early stage companies to raise money is on the back of a convertible note. And what that means is an investor provides money to the company, basically on the basis of a loan, but the intention is not that that loan is repaid. The intention is that it converts to shares at the time of the company's next capital raise. And the benefit for the investor in that process is that when it converts at a discount to the valuation that you receive or that you negotiate at your next capital raising round. And they can be really helpful because you can enter into the convertible note without having to get into all of the detail about investor rights, director appointment rights and things like that. It's really just a commercial get money into the company kind of deal. But there are some downsides to that.
Yeah, I think the downsides are you're kicking those terms down the road. So sometimes investors like to know what they're getting up front. So go through the process. It's actually not that much more onerous to get a simple shareholders agreement and issue shares. I mean, the company's office in New Zealand is very easy to deal with. So we find that the downsides mainly of convertible notes is the uncertainty. Sometimes you do want to just know what terms you're on, you're putting a certain amount of money in and what you're going to get at the end of that. The worst is some of the uncapped convertible notes, because you really don't know where you're going to end up at the end of the day. And for you want to know, you want to try and estimate what your returns might be at the end, down the track. And probably the worst, the uncertainty, and also you're pushing a problem onto another day are probably the main concerns for us in convertible notes. They do have a use in certain situations, but and the flexibility can sometimes be useful, but sometimes you want certainty as well.
As a founder, you should, to minimize cost and to maximize your negotiating flexibility, you should just make the investment in legally upskilling yourself over all of this, so that when you use the lawyers, it's hey Julie, I have this opinion, what do you think? And then she can say yes, no, push harder Ben, you're being a wimp, whatever. Or, oh yeah, we'll deal with that bit. And then that massively reduces your costs, and it just makes you a much more competent negotiator.